Great, as always, to have you on the show. I want to pick up right there, Mark. I was talking to Julie about the big banks, front and center for investors today. You had bank executives making headlines, Mark. I'm interested as a technician. You're looking at the charts for the big banks. What are they telling you here?
Well, let's not forget, Josh, that banks were up about 10% over the last 3 months. It was one of the best performing sectors in the entire market. But it's always important to keep an eye on the financials. I mean, they're literally the second largest sector in the S&P behind technology. So, you heard reports of JPMorgan, net interest income could be a little lower. Trading revenue being hurt on the fixed income side as rates have pulled back sharply. I don't view this sector to be in all too much trouble, technically speaking. I mean, it's still been in excellent shape. Yes, we do see a minor pullback, but that's on the heels of really robust gains in this sector over the last few months.
And so let's broaden it out a little bit and talk about what you're seeing in the market. I know you've been watching the S&P equal weight pretty closely here. And we've been talking a lot about the broadening that we have seen in activity. What is that? What are the implications of that for the sustainability of stocks going higher?
The implications are simply that the market's not nearly as weak as what people expect and what they think. I mean, everybody has their eyes on technology for good reason. It's 30% of the S&P, but when you see 5 sectors hit new all-time highs at the end of August, that being technology for one, financials, healthcare, industrials, and utilities, that's a sign of a pretty healthy market. So yes, we do see tech slipping. We've not broken down substantially enough to think that tech is broken. That's the one thing. Certainly in a new era of cross-asset volatility that investors are trying to get their heads around. It's really been FX, honestly, and what's happened with interest rates, much more so than the equity market. But it's always difficult to lose, 4% in the S&P over the last week. When you start off a month like September like that, historically, that is troublesome. Normally you do have an average of about a 2% decline for the month. We are in an election year, of course. Seasonality dictates that normally this is the time that markets are weak. And so we expect to see a little bit of a pullback. The question is, is it a minor correction or is this the start of a major big deal? I would argue that given the fact that sentiment is really not that optimistic as I would want to see at a market top and the breadth remains better, it's going to be a hiccup. I think, normally election years are great. We have this huge amount of contentiousness and divisiveness regarding the election, of course, 2 wars overseas, a lot to get us unhappy about. Earnings, though, have been remarkably good, and the stock market itself has been good. So, let's not get too bent out of shape about, granted some understandable major pullback in some of the semiconductor stocks. I don't think it's been damaging enough to say that the market has peaked out, honestly. But it is an uncomfortable time for many investors. Sure.
So Mark, if the SPX here is at 54.88, what would be your year-end price objective?
I do suspect we probably pull back a little bit further, even over the next week, you can't rule that out, so maybe to 53 and change. Then I think we probably start to turn higher after the Fed meeting. Tomorrow's data, as you mentioned earlier, Josh, is important. Fed meeting, very important. Right now we're pricing at about a 35 basis point cut, so right in between 25 and 50. 50 would likely be seen as too much. And historically, when that's happened, 2007, 2001, that's been troublesome. My thinking is the market ends the year probably at 5,800 or higher. And the best times of any election year typically tend to be buying weakness into the election, November into next spring, really should be the sweet spot for investors. So if you want to make money in this day and age, in this time period between now and the election, you have to be very well diversified. Healthcare, I would even argue financials, JPMorgan at $200 is a steal. In my view. But really, utilities, REITs, gold looks very, very good, but you have to be diverse. You can't just be 100% in technology, unfortunately, or if you do, you have to watch that very carefully. And after the election, I think we'll have more of a broad-based recovery where everything works between November and next spring.
Now, I want to circle back to something you said. We were looking at the VIX before, kind of ticking up a little bit, but other assets we have seen more volatility. The MOVE index, which is bond volatility, moving up a little bit. We're also seeing the dollar volatility creep up a little bit. FX, you mentioned. How is that interplay sort of working with stocks, and what does that tell us about sentiment out there?
Well, there's a couple of things to mention. One is that the positioning in the yen has actually grown a lot more bullish in recent months, and it's gone from really one of the most negative levels on record. We've seen shorts that are now back to really quite positive, the positive in the last couple of years. So that means that this whole unwind carry trade likely is not going to be able to continue. In other words, people borrow cheaply in yen to maybe buy tech stocks. Now they're forced to liquidate as the yen goes higher. The yen has a very sharp, serious floor around 140 dollar yen, in other words, a floor. So I expect to see a little bit of a bounce. We've already started to see that in the dollar as Trump has started to talk about potential tariffs. So the dollar has stabilized, has started to turn higher. The volatility is, a source of major discomfort, I think, for everybody across, all asset classes. But I sense that, we're nearing a time when bad news is no longer going to mean good news for stocks. The economy has started to weaken along the fringes, not major weakness, grant you, but the labor market has seen weakness. So, yields have already pulled back very, very sharply. My thinking is yields and the dollar are close to a short-term floor, which means, further deterioration in economic data likely would be more of a negative than a positive for stocks. Yields likely bounce, potentially starting tomorrow, potentially next week after the Fed unveils its plan. We get more clarity, and then, we probably see a little bit of a rally between now and into October. But, granted, we're in a dicey time. Historically, it's been difficult when the S&P does lose ground the first 4 days in a very rapid session, being down 4% on the first week of September. Very, very difficult to get our heads around what's moving, but a lot of it is technology. And if investors take the time to research, all these other sectors are acting phenomenally well up until the last couple of days. And like today's weakness in financials is really a drop in the bucket. It's not the signal of a major top in financials, in my view. Banks are going to be able to weather this, but rates have been headed lower for the right reasons. So.
JPMorgan at $200 a steal. We got a bank analyst on later. We're going to have to ask him if he agrees.
We're going to buy him, Mark, see if he agrees.
Yeah, exactly.
Absolutely.
Good to see you. Thanks for
Likewise,
coming
thanks,
in. Really
Julie.
appreciate it.